Hello one and all, and welcome to Let's Go Financial. My name is David, and this channel is dedicated to saving you time and money by focusing on the things that matter most. Now, when it comes to investing success, diversification is a very important aspect to master. It is not simply the purchasing of a little bit of everything, but rather it is the purchasing of the best of everything, and then managing those purchases to best maximize the value of our wealth and our income. In this video, I'll shed light on how we can do this effectively. So whether you consider yourself new to investing or whether you consider yourself a seasoned expert, this video will have something for you. So let's do this. We have entered a period of time where investment risks have risen significantly when compared to past decades. Therefore, we can expect to see more extreme price fluctuations in everything. So whether we're a short-term trader or a long-term value investor, to survive financially, it has never been more important for us to protect ourselves against this added risk. The degree of our success will be determined by what we purchase, at what price we purchase at, how long we hold those purchases, and how well we manage them. In this video, I'd like to highlight a technique that we could use that makes this whole process so much easier. To help you remember this strategy, I'd like to use the analogy of this table. To begin with, I'd like you to consider this tabletop as representative of your entire wealth. Yes, everything that you own. Now, for you to consistently grow your income and build your wealth, then this strategy demands that you work towards diversifying the value of everything you own into at least 4 areas: cash, stocks, cryptocurrencies, and property, as demonstrated by each leg of this table. Now, if you don't have property, then that's okay. It just means that your table has only 3 legs for now, until you work on getting that 4th one sometime down the track. It's important to note that each leg of our table is like a pillar that supports our overall wealth, and each pillar is diversified within itself, and I'll talk more about that later. Now let's just say we had $100,000 to allocate to our overall wealth. Well, then we'll put 25% or $25,000 into cash, $25,000 into stocks, $25,000 into cryptocurrencies, and $25,000 into property. Now you might be thinking that $25,000 is a very small deposit on a very small property, but it is a property nonetheless. Anyway, at this point in time, our portfolio is considered balanced. But inevitably, when we enter the financial markets, it will never stay that way. Each leg of our table, as represented by each asset class, starts moving up and down. But at what point do we intervene? It's when the profit portion, part of an asset class, far outweighs that of its peers. Then we sell down that profit portion to the other asset classes, and then our portfolio eventually comes back into balance. So if we had a mortgage on a property, then we could sell down that profit portion leg of our portfolio and use those funds to pay down our mortgage faster. Now, some of you may be asking, how much higher will the asset class that's performing need to go before one can decide to distribute some of those funds to the underperforming asset classes? Well, the truth is, much of it depends upon you. It will depend upon things like your personal risk tolerance, your conviction rate of that particular asset class, or your general financial literacy. Which brings me to my next point, and that is you and I. You see, our wealth is not simply supported just by 4 legs, it is actually supported by 5. The 5th leg is you and I. Why are we so important? Well, we can have the biggest impact on how our wealth and our income will develop over time. We are our biggest investment. So why not see ourselves as that 5th leg, one that can contribute? The whole purpose of this strategy is to mitigate against prolonged periods of negative return. This will typically happen if we only have exposure to 1 or 2 asset classes. By having exposure to 3, 4 or more asset classes, our overall return should be smoothed out. This also puts us in a better position to take advantage of opportunities as they arise. The same principles used when managing the table legs are also used when managing each leg individually. Each leg is a diversified asset class within itself and will also need attention. So how can we go about doing this? So let's have a look at our cryptocurrency leg as an example. In this example, we distributed funds evenly across 6 different cryptocurrencies, and that's how we would start. Now you may notice that some cryptocurrencies are highlighted in bold. This just highlights to me that they are part of a new standards body called ISO 222, which is revolutionising the way we do finance. I personally place greater importance on these cryptocurrencies over the long term than any others. But as you can see, our portfolio has an even amount of funds across all 6 cryptocurrencies. Now, over time, one will outperform the others. This is inevitable. So we take the funds from that overperforming cryptocurrency and redistribute that wealth to the other ones that are underperforming. Eventually, once we've done that, our portfolio is considered balanced once again. I would like to note that each leg of our table can actually be set up to produce real-world income as well as put us in line for good capital growth. Now you might look at the cash leg of our portfolio and think, how is this even possible, seeing as how the return you can get on your cash or by leaving your money in the bank is less than the inflation rate. So by leaving your money there, you would actually be taking an annual pay cut. And this is true if you view cash in the traditional sense. There are many ways that we can view cash, but I'd like you to view cash in terms of gold, cryptocurrencies, as well as fiat money like US dollars and Aussie dollars. The key point here is that the funds are liquidatable and that they don't fluctuate too much in value. You can quickly sell them down to make those purchases you need or to pay those bills. So why gold? Well, there's been countless currencies go bust over the last few thousand years, but gold has stood the test of time. It's survived all of them and been able to retain its purchasing power. It's internationally recognised, and it's also easy to find a place to buy and sell it anywhere on the globe. So why cryptocurrencies? Well, they have also proved to be a great hedge against inflation. They are easy to buy and sell. There are many exchanges out there now that will do this for you. Sure, they're volatile as they are a new asset class, but there are exchanges as of today that will give you between 3 and 17% annual percentage yield just for holding them. Exchanges like Celsius, Nexo, and BlockFi. So it's well worth considering having some cryptocurrencies in that cash fund. Why cash? Well, we all need cash to pay for our daily living expenses, as well as to have some funds aside to take advantage of that next opportune investment purchase. This strategy is designed to be general in nature. It is impossible to cover all the variables out there, things like your personal financial situation, tax implications, or simply how to value something using fundamental analysis. Hopefully, though, it's been able to open your mind to new possibilities and ways of doing things. I hope this video was helpful in giving you the basic concepts of why we need to diversify and how we can go about doing it. The attack on the middle class is intensifying, but we are not without direction. By being vigilant now and diversifying against this added risk, we can position ourselves not only to weather the storm, but to prosper.